Welcome to the Thematic Edge. I'm here with my good friend and former colleague, Mark Farrington of the Global Watchtower. And I am just going to remind you up front that everything that we talk about on the Thematic Edge is for informational purposes only and not intended to constitute financial, investment, legal, or tax or other professional advice. You should do your own homework. With that said, I want to jump right into it. We've got so much to talk about, Mark, but I want to focus on two big themes in this conversation today. The first one is around what's going on with the Fed. There's been a lot of focus on who the next Fed chair is, what that's going to mean for interest rates. And I am increasingly of the view that markets are definitely on the wrong track in terms of what they're focused on there. As not just who is going to be chosen as chair of the Fed, which
Yeah.
I've had a very different view from other people, but also what that means and what we should really be thinking about, regardless of who's chosen. And then the other big topic out there is there has been so much commentary about the latest national security strategy of the United States and what that means for the sort of global political economy, which of course is going to have big implications for economic development around the world and global capital flows. And I think there's a tremendous amount of misunderstanding on that. And I know that you've written a lot on this. In fact, actually, I would refer everyone to your Global Watchtower piece where you provided a bullet point summary. And it's a very unbiased, I would say, just like straightforward, just the facts, ma'am. This is what they're
Yeah.
saying in here. And if you don't have time to read the whole thing, which I would encourage people to read it, fantastic. Just Cliff Notes, short form version of this. I highly recommend it to everybody. But that's what I was thinking are the sort of key topics that I think we need to dig into this week, if that sounds okay to you.
Yeah, that sounds great. I like both those topics.
Okay, so let's start with the Fed. And I wrote something at Thematic Markets recently about uh, who I thought the administration was going to choose. Betting markets were at that time about 75% Kevin Hassett. That shifted now. And it turns out that my call was pretty darn good on that because I said, no, you got it wrong. It's going to be Kevin Warsh. And so then we have this Wall Street Journal article that says, oh, yeah, I'm really down to Kevin Warsh and Kevin Hassett. So now those two guys are much more at even odds. And I still think it's likely to be Kevin Warsh. I go through in the piece a lot of reasons for that. But I think the broader picture is this one of whoever it is, people have been so focused on the idea of Fed independence and about the president's relentless push for lower interest rates that
Mhm.
they haven't been paying attention to the broader picture of what the administration has been saying. And there's a very, very consistent message coming out. You want to, if you step away from the we want rates lower, the president is the main person saying, and listen
Yeah.
to every one of his acolytes,
Yeah.
they don't talk about interest rates. They talk about the Fed and
Yeah.
its institutional structure and how that institutional structure has gone awry and how it needs root to branch reform,
Yeah.
and that's going to require significant changes to the regulatory structure. And I've written about that over at Seriously Marvin in terms of this horrible monster that is Basel III, that is like one of the most ridiculous sets of regulations ever created, that is just like this constant evolving monster that keeps getting bigger and bigger and more complex and less logical because each one of its rules creates new problems that they then have to address, build another one. And I related to this, you know, nursery rhyme when I was a kid about, there was an old woman who swallowed a fly. So then she swallows a spider to swallow the fly. Then she swallows a frog to swallow the spider. And it just keeps going on and on and on from there. That's what Basel III is like. And they're talking about rolling that back. And I think there's a lot not only good about that, but I think in terms of if you think about the market implications of all of this, it's far different than focus on just where Fed policy rates are going to be next year.
Mm. Yeah, I completely agree with you. I enjoyed reading your thematic markets piece very much, this one. Also, because there was a bit of a break and I was wondering what you were thinking on some of these big issues. And then you wrote this excellent piece. And one of the points that stuck with me the most was this idea that Trump is going to choose someone that he really knows well and that has been loyal over a very long period of time. Not so much loyal in terms like, mafia type of loyal, but loyal in terms of true to their worldview and their ideological view about government and private sector. And so I think he really wants to trust this new person to continue the legacy, well beyond just what the rate cut cycle is this time around. So I totally agreed with that insight. I thought it was astute and does boost Warsh's chances. I also saw an interesting comment from, I think it was Wellington's chief economist, who was saying that there's a connection between Besant and Druckenmiller and Warsh, and that also boosts his odds. And I think that's an interesting way to view this too, because I think Treasury Fed collaboration is a big part of the story now, both on making the recommendations to Trump, but also convincing Congress if there's any need for legislative adjustments or change to Federal Reserve law or whatever. I think you need to have, a broader consensus. So this just isn't viewed as some, quick fix to allow Trump to get short-term interest rates in this cycle. I mean, the thesis about why we need to restructure the Fed and what it's going to achieve for the banking sector, for new decentralized financial sectors like Bitcoin and stable coins and cryptocurrency, etc. I think someone's got to be able to make that intellectual case, and I think Besant will be looking for a partner in that. And so this idea that there's a little bit of a network between Besant and his previous world and Warsh starts to look interesting as a way to present a strong case to Congress. And Trump might be interested in that as well as getting lower interest rates.
So I think well, one on that broader picture about coordination. I mean, there absolutely is going to have to be coordination here.
Yeah.
Um, you know, even though you said not mafia-like, I actually likened it to the mafia. I've likened Trump to the mafia multiple times now because I think it's actually a very useful model and not in the pejorative way that people tend to think of it. So, I took one political science class when I was an undergraduate, and it was, this brilliant political scientist, Ken Jowett. And, if you went to UC Berkeley, everyone said, if there's one class you absolutely have to take because this guy's lecturing is amazing, his thought process is amazing. And let's go. Ken Jowett's Intro to Political Science, and that was definitely not a disappointment. But one of the things that he said early on, and I thought was actually a really great educational device for me, is he said, "Look, if you want to understand all of sort of human organizational political thought, you need to read three books." The Iliad to understand ancient man and the way he thought about the world,
Mhm.
um, Mario Puzo's The Godfather to understand how traditional societies think about interpersonal human relationships,
Yeah.
and Arthur Conan Doyle's Sherlock Holmes to understand how modern, individuals' Western man looks at human relations and or organization. And this actually, that's it is absolutely true. And the thing is that most of the world still lives in that Mario Puzo traditional framework. And this
Yeah.
is one of the reasons why I think people don't get this. Trump actually plays much better in the global south than he does in the west. Like he does very well there. And it's largely because they're like, yeah, I get this guy, right? It's the
Yeah.
exact same sort of traditional, and that's not about, going and knocking off somebody or something like that in the mafia sense. It's about the way humans relate. And he
Yeah.
does still have that very traditional set of values. And when you talk about um, sort of loyalty, like,
Mhm.
look, I think in the first administration, we got this impression he was in a new realm he'd never been in, and he's being offered all these advisors who um, are new to him. He knows nothing about them, and so yeah, I think the last person speaking in his ear had a big effect
Mhm.
because this is a totally new realm. He has no idea what he's doing here. Well, now he's actually spent some time, and the actual Donald Trump that, is a pretty shrewd businessman who has that traditional, you know, call it mafia framework for thinking about human relations.
Mhm.
Actually, he doesn't trust the last person who spoke into his ear. He's much more about, what do I see? How have you been with me my whole life? The way a
Yeah.
mafia boss would be. And what is your philosophy is? And that's one of the reasons why I think Kevin Warsh sort of stands out here is that Kevin Warsh has been longer than any of these people on the Fed is out of control, screwed up thing. He was a Fed insider. He was critical to the Fed's response to the global financial crisis. He was relied on very heavily by Ben Bernanke. Um, uh, um, uh, by Tim Geithner, all of them, they all leaned on him a lot. He was seen as a critical person in this. And then when he leaves, he has this mic drop moment where he's like, screw all of you. You guys are screwed up. You guys are doing too much with the balance sheet, whatever. This is back in 2011. I mean, we're going back almost 15 years. This guy has been criticizing what the Fed has become. And
Yeah.
he did it as he left, right? Like he
Yeah.
did this as, I'm getting out of this because I don't agree with what you're doing. Now, whether that was him promoting himself or otherwise, I'm not going to speculate. I can see that as a possibility, but he's been there as this institution needs complete reform. And so I think that is a big issue here. Whereas none of these other people have been on that bandwagon that long.
Yeah.
He actually believes this from day one.
Yeah. Well, I can say I was a card-carrying member of that bandwagon from the
Yeah.
beginning. So he earned nothing but my respect as he continued to speak on the topic after he left the Fed. And I'm sure you had the same experience. I just can remember through a series of mini crisis events from 2008 onward, where it didn't matter whether it was in housing or whether it was in trade finance or whether it was in community, credit unions and other forms of government subsidized lending, etc. The response to everything was, don't worry, we'll just flood the market with liquidity and
Yeah.
QE will solve every problem we have. And I just felt this was so unintelligent and so, you know, 1970s type of mentality, just like flood the system with liquidity because figuring out what's actually really broken is just too damn hard. And it reminds me, my one anecdote with Warsh, which you claim not to remember, surprisingly, is you and I went to visit him right in the heat of the crisis in 2008.
I remember that.
And and one of the things that he said, well, what do you guys think? And I told him my experience from running, a big $10 billion currency overlay portfolio where we had credit lines with everybody, how we've had to just cut all our counterparty risk. And because we don't know, not because we don't think they're not going concerns, but because when you don't know, you can't answer the question of your
Yeah.
credit department. They just cut. And I was explaining that phenomena to him, and he said, "Well, okay, so what's the solution?" And I can say, I told him then, well, the solution is, what Japan and China are doing, which is activating their government balance sheets, the Export-Import Bank, the various types of development banks, local community banks, etc., because the counterparty trust isn't an issue there. So
Yeah.
I said the US needs to do the same. And he was like stunned because he said, I don't know, which ones we have in the U.S. other than the Export-Import Bank, because the Fed never even thought, well, let's get out there and activate all the institutions we already have that could provide credit in these pockets, which were where there was no subprime. It was just this blanket collapse and counterparty trust. So I remember that event because he was least curious and interested what are the levers that we could actually do to put out that fire and that fire so that everything doesn't become considered a subprime, derivative market story? Because most of them were not. They were second and third round effects. And so I like that mentality. I think that's the way we're meant to address the financial market shocks is you have to find out what is the problem and then the solution for that is always different than the solution for the second round and third round effects. Those require different policy measures which may or may not be monetary policy.
We are sometime going to have a whole conversation on that whole window and exactly this point. I was just thinking about, frankly, beating my head against the wall while I was at Treasury just before that, in terms of trying to get them to, think about getting the Fed to act in foreign exchange swap markets, which is not foreign exchange intervention. But they kept telling me it
Yeah.
was, and I'm like, no, it is not. It is providing funding. They just could not get this concept.
Such a
It was unbelievable how completely ignorant most of the people in that situation were of what their tools actually were and how they worked. It was unbelievable.
yeah.
But we will have to do that. But I want to get back to this point about regulatory reform. And one of the issues is, I wrote this piece about Stephen Myron's speech about bringing down the balance sheet and about um, regulatory dominance and how that is forcing the Fed's hand. And there is a whole issue about this, which is the Fed's balance sheet, which they're all criticizing and saying they want to bring down, they want to get it lower. And when I say all of them, I mean the entire administration, which should, by the way, raise some
Mhm.
alarm bells if you have this model that they want to monetize the debt, because it's really hard to monetize the debt if you're also saying at the same time the Fed needs to stop buying treasuries. So
Yeah.
hard thing to do, but I don't know, maybe they have some other sort of devious plan I haven't thought through. Anyway, they Governor Moran makes this very good point, which is that their constraint really is that because of that whole sequence of every single crisis, as you described, every single little hiccup in markets, they say, well, we can address this by expanding the balance sheet, by buying more treasuries, by providing more, quote, liquidity. And that
Yeah.
is a very misused term, by the way, but that's for another
Yes,
discussion.
exactly.
um, that we will solve all these problems. And all they do is create more problems, but they've also created effectively this floor system where they have to provide infinite numbers of reserves, or a significant amount of reserves in markets, and that the counterpart of that is buying all these treasuries simply to keep the Fed funds rate where they want it, as opposed to the pre-2008 corridor system where they had a much smaller balance sheet, but they intervened on both sides of the market to force the rate into the corridor they wanted it to. Um, and,
Yeah.
you know, Myron makes the very good point that all of this comes down to regulation, that the um, uh, um, liquidity coverage ratio, this requirement to have liquid assets on your balance sheet, that the leverage ratio, the requirement that you can't have too large a balance sheet relative to your capital, even after you've already adjusted for what your risk-weighted assets relative to capital, and then you've got this net stable funding ratio.
Yeah.
Anybody who's confused by all these things, you should be confused by them. I try and do a good explanation of what they are in this piece at Seriously Marvin, the bank that swallowed a fly, following up on that earlier analogy. The point is, those things force the Fed to have a large balance sheet. So Moran is very explicit in that speech. He says, I would
Yeah.
like to slim the balance sheet further. I voted for us to continue QT to this point, but now I have to stop because now we're running into regulatory problems where we're going to create market functioning problems if we slim down the balance sheet further. And it's regulations that are getting in the way. And I think this is the critical issue that people are missing. This is what they're really focused on, is actually getting rid of that regulatory structure that is forcing the Fed into this position of having a large balance sheet. So, that
Yeah.
far more than interest rate policy, I think, is the big goal of all of this, because whether it's Besson's op-ed in the Wall Street Journal, whether it's Moran's speeches, whether it's Hassett talking about this, every single member of the administration has been talking about the Fed's balance sheet needs to come down. The Fed needs to be a smaller share of markets, and regulation is a serious problem.
Yeah, I have to say, I read through that section in your thematic markets report twice because it was some dense sledding. And I think maybe I'm a typical market participant. The Basel framework and all the different ways to say the same thing are just so dense that I don't immediately intuitively understand, okay, well, this is the regulatory change that needs to take place in order to produce this behavior outcome by the banks. Because then there's too many trade-offs, So to predict what the banks would actually do if you change just this one bit of regulation. So in the end, I just concluded, I think the way that you did, which is it's a holistic regulation overhaul that needs to take place, because change on one of the ratios is not going to produce much behavioral change. So like for me, I just think banks should not be big duration traders. I mean, I know their job is to be transformation providers, but historically there wasn't any need for them to go beyond 5 years. The banks, yield curve that they need to make money on is overnight funding to 5 years and everywhere in between, with like a high concentration of those corporate loans, sort of 1 year or 2 year, etc. And they should really have no business owning any long duration assets. But with QE and low interest rates and credit impairment through the 90s, they began to dabble in long duration assets. So I want to see banks short term yield curve managers only, and I also want to see the long end affected by regulations, particularly through GSE reform, which I think I've brought up with you before. I will note the one positive thing about the Treasury operations to buy T-bills is they will be swapping T-bills for MBS as it matures. So get all the credit off of the Fed's balance sheet. That's a plus for the market. But then spinning off, privatizing the GSEs and doing something with that so that Fed monetary policy isn't responsible for influencing a long end of the curve and driving refi cycles in the housing market in the US, etc. That's really not the Fed's job. And there are other ways, I think, to address both the funding side and the mortgage product side to change this relationship between the huge housing market in the US and Fed monetary policy settings.
Yeah. The Look, I think that's part of what they're talking about in terms of they don't want the Fed to be have as large a footprint in the markets. Ultimately, the theory of the yield curve, which actually does tend to work, says the Fed's front end rate and their appropriate management of it is what drives the long end. I mean, that's never going to go away. The
Yes,
point
true.
is whether they should be, you know, alternately intervening with their balance sheet on that, which I don't think they should. It seems like you don't think they should, and clearly the Trump administration doesn't seem to think that they should. And so, the question is, what can they do without this? And we have a whole line of different bank regulations built over the last century. But it turns out that actually, and this is why I think the Fed, the more I look into this, the more all of the focus on the Fed and them screwing up and beating up the Fed, it seems really increasingly clear to me that this is what it is all about. Because it turns out that if you control the Federal Reserve Board, so the 7 seats on the Board of Governors, not the presidents around there, but if you control the Federal Reserve Board
Yeah.
and you control the Office of the Comptroller of the Currency, which the president does,
Yeah.
the FDIC, which is also related to bank funding.
Yeah.
All four of those big ratios that I talk about under Basel III, which, again, I'll refer you to this piece. Go read about it. You can be confused about it. It's at Seriously Marvin.
Yeah.
The bank that swallowed a fly. The key point is you have these four contradictory ratios that are creating all sorts of havoc.
Yeah.
And every one of those ratios can basically be adjusted by the Fed. And so the two really big ones for treasury market functioning and the size of the Fed's balance sheet, the liquidity coverage ratio and the leverage ratio, can be completely determined just by the Board of Governors. The other two, the net stable funding ratio and effectively RWA capital weights, which all comes through how you regulate the banks, can be done in conjunction with the Federal Reserve banks, the OCC and the FDIC in terms of regulating all of those. So you don't actually have to change any legislation. Now, ultimately, I think they want to. I think they want to reform the Fed broadly and make this institutionalized, but they can actually completely change the entire how all of those constraints bind just by themselves.
Can I
That's
ask
what
you a
really,
question on that?
yeah.
If they do change those ratios domestically, how does that impact the too big to fail large systemic banks operations in global markets, where Basel is still going to be the preeminent regulatory hurdle to clear?
Yeah, well, so look, this is actually the irony of that is that they can have more effect on those guys than they can on the uh, um,
Like small regional banks.
on the small regional banks. Because the
Yeah.
small regional banks, one of the crazy things about the Basel Accords is that they have these loopholes that basically say, well, we have these risk weightings for assets. Um, a corporate loan is this much risk, a treasury bond is this much risk, a mortgage is this much risk, all these sorts of things. But you sophisticated banks out there, you gigantic, big, globally systemic international banks, if you want to, you can come up with some complex model that we will then approve that adjusts how much capital you really need. Wink, wink, nod, nod.
Stop. It can't be true.
Now, there's this whole Basel III endgame that's supposed to limit that, but actually all it does is make it more complex. But that's another whole issue. And the US isn't implementing that so far. The UK has, Europe is phasing this in. The US has sort of put this off. And so, this is where what I said about the ability to regulate the banks. And here's where they are going to need the Federal Reserve banks. And this is part of why they're attacking the Federal Reserve Bank heads as well and saying, oh, well, these guys, why do we have people from New York managing, one of the Federal Reserve district banks out in like Kansas City or something like that? Shouldn't it
Yeah,
be, people from that district? Which is,
yeah,
of course, what the Federal Reserve System was set up for, is to have
yeah,
actual representation from across the country to
yeah.
make it much more democratic and decentralized. That was the point. But part of this is they want to put pressure on those guys to change how they regulate banks because they are ultimately the supervisors on the ground. And
I
so
see.
that does that. So in answer to your question, you know, ironically, they have more degrees of freedom with the GSIBs than they do with the small community banks, which, by the way, is going to put more pressure on Congress to come back and change this, right?
Okay.
And say,
Interesting.
ultimately do that. But a lot of this they can do just by controlling the Fed, and they can start to control the Reserve banks because it'll take time for those guys to change over. Most of them have, terms until they retire. I can't remember exactly what the length of a term of a Fed president is, but ultimately, even though they're chosen by member district banks,
Yeah.
those boards, the Fed has a veto power over it. The Board of Governors has a veto
Yeah.
power
Yeah.
over that.
Yeah.
And so they can influence a lot. And so far, that influence has been used to put in people that think like them.
Yeah, that's another
I
thing.
suspect they will do is put in more to say, no, you need to choose someone local. You need to choose someone who represents your local community banks and do that and make the Fed far more decentralized.
That makes sense. Okay, another quick question for you then. The banking sectors have had a fantastic year. European banking stocks up 60%, I think, for the year, and KBW in on Nasdaq is up 30%. So you know, I know the yield curve is correcting and we're finally getting a positive slope to the yield curve, which is a positive for the banking stocks. But is there some anticipation that this deregulation and reform is going to be positive for return on capital? What is there a connection to the rally in banks,
Look,
basically?
I don't know. I
Hmm.
suspect there is some, but I do think that people, some because I don't hear enough about this. I
Yeah,
think people significantly underestimate this, and this is really mostly about the yield curve and sort of blah 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 deregulation. Okay,
yeah, yeah,
I
yeah.
should
I
buy
see.
banks. I don't think people get the extent of this. And so, one of the things I would take away from this, to
Yeah,
exactly your point, and I was looking at the KBW index just today, I was like,
yeah,
oh, hey, actually, in preparing
30%.
for our conversation, I was thinking about this. I looked at this, I'm like, it has run up. It's outperformed the S&P 500 this year. And you say,
Yeah.
well, at that point, do you really want to buy into this? But I think this is if this is the path they're going down, then no, this still has a lot further to run. So I think actually, in the long run, the push towards stable coins and narrow banks versus fractional reserve banks is a bad thing for banks. But if we're
Yeah.
talking the next few years, I actually think this whole deregulatory push is going to be very positive for bank stocks. So
That's good.
yeah.
Well, definitely the yield curve is. I mean, this is like first positive slope yield curve we've had since the inflation episode started in 2022. So that's positive for banks. But also, I was looking at a report from Goldman Sachs, which was showing, yield curve patterns over history in terms of predicting recession or not predicting recession. And there are plenty of episodes where you get a steepening of the yield curve and it isn't signaling a recession. And so those are pretty bullish for a stock market because it means, lower short-term rates and a better growth outlook. And that does match the current circumstances. And it starts to look a bit like, 1996, where, we had that little mini tightening episode by the Fed in 94, which created some pause in growth in 95. But then,
Mini tightening, the blood
mini
in bond markets. Mini tightening. I like that.
Yeah, yeah. Well, Yeah, I guess so. It was some insurance taken out because I don't think Greenspan had settled on his productivity thesis yet, but he could
No, he
see it
had.
coming, and he needed to buy some time. It feels a bit like that. I mean, we've got this AI bubble and sectoral investment home buyer story in the pipeline. We just don't know when it's really going to produce the broad macro growth. Although all the Fed FOMC members seem to dramatically raise up the growth outlook for 2026. So we've got this story of lower short-term rates, but an upgrade in growth. It starts to feel like 1996, which is bullish for banks and also continues to be supportive for the AI and tech story.
Well, we've talked about this before. There's a reason why I try to ignore what the Fed is saying because their forecasts are always worse than mine. I have a consistent track record of outperforming them. So I'm glad that yet again they are
Catching up.
catching up to my forecast that I've been telling you all along, but whatever. Anyway, hey, look, I think there's one we should probably switch topics here because we only
Yep.
have about 20 minutes left. And
Okay.
I do think that the national security strategy, there's a lot of sort of myths around that. Or I think bad interpretations of it. You've spent a lot of time digging into this. Why don't we start with you just sort of highlighting what you think are the key things that, from a grand strategy perspective, what is the national security strategy actually saying? And
Yeah.
how is that a change from what was US grand strategy previously? How has that changed?
Well, I think the mainstream press hysteria is so disappointing. I really keep hoping for evolution, but it never happens. They're so obsessed with analyzing break-in precedent, word count, page count, how many pages allocated to Europe versus how many pages allocated. No mention of North Korea. These, I don't know what to call this. It's like an editorial lens to analyze documents rather than a content analysis. If you have read any of the, strategy documents coming out of the Defense Department or read the war gaming that is well published in security think institutes like CSIS or IIS, etc., there's a clear continuity, which was what was, put in this NSS versus what those exercises have produced. The US is conserving resources. We know this. It's pulling back from, what used to be called imperial overstretch. It's trying to allocate its scarce budget and resources in the areas that require the most investment to upgrade and where the risks are the highest. And I think if you just take out all of the emotion and the fear, and just look at the bare bones of what is written. The document is basically like that, which is what motivated me to just, do cut and paste bullet points from it and put in that Substack piece that I published. Because basically for Europe, it's just, highlighting that, it's got this enormous, wealthy, longtime partner in Europe that can certainly handle the risk environment that we have there. It does not need the US to coddle it anymore. So that message has been going on for 10 years. It should not be a surprise. It's just evolution of that. In Asia,
I would just
yeah.
interject that you could argue that message has been going on for 50 years. I mean, literally every single president since Nixon, every
Yeah.
single one, without exception, has gone to Europe and said you need to spend more on defense. You're
Yeah.
you're you're not pulling your weight.
Yeah, but now you actually have a live risk. Before it was hypothetical. Now you have a live kinetic war on your Eastern Front. It should be obvious. You shouldn't need to be told anymore. So there's an element of just buying time. Europe is asking for more time. US is saying, okay, we'll give you more time, but show us some better signs that we're in a agreement on the long-term vision. It's a bit like that. So I would say a kind of sibling spat there rather than some retreat or withdraw or whatever. In Asia, I think there are some harder questions asked, but I think people, and I wrote this in my Substack, people are using the wrong framework to analyze U.S. Announcements now. They think that we're in this world of global peace and where transparency is the number one priority. The U.S. has already retreated to a bit of a Cold War posture where it doesn't telecast everything that it's doing anymore. And in fact, uses deception very often because we're in a global rivalry with China, and it is Cold War-esque. And China is, whipping out all of the USSR playbooks and playing the Cold War game themselves very actively. So if you know how to read between the lines and look at concrete actions taken by the US, even the Asia bit is very, very clear where the policy priorities are. All the focus on the first island chain particularly perfectly relates to all the wargaming that's been done by the Department of Defense on how to combat and deal with things like invasion of Taiwan or blockade on Taiwan, etc., and how to manage global shipping and deal with all the merchant fleet issues and electricity. I mean, some simple things like people don't understand. Taiwan is so dependent on imported energy. With a blockade, they run out of any energy to run their economy in like 1 month,
Yeah.
So
They
like
run out
half
of
of,
food within 3 months. Like,
yeah.
I mean,
So
people
yeah,
just do not get that China does not need to actually invade. They just need to blockade it, and they
exactly.
can.
So I recommend everyone go and listen or read the CSIS Wargaming on Blockade, which was, published I think in the summer, June, something like that, because it highlights.
Or they could read thematic markets 2 years ago that said the exact same thing. But
Okay, there you go. Yeah, because of course, 2 years ago they did the invasion war games, which told the story that everyone heard that pretty difficult and pretty bloody conflict, and would the U.S. actually get involved? Now the blockade is a second derivative of that, and it has a completely different contingency story, and that is what created the spat that we now have escalating between China and Japan, because the blockade contingency absolutely involves Japan. It immediately, interferes with all the shipping traffic that go through the Okinawa Islands or Ryukyu Islands, however you like to term them. And Japan has been building up their military installations there. In fact, they call it, the mobile island, defense as they upgrade all those islands. And China would be intervening in all that in the event of the blockade. So all of the innuendo and comment and urging of allied support is all about an investment between Philippines and Japan with help from Korea and Australia to prepare for any contingency with China. And the US is upgrading all of its infrastructure and the second island chain and its ability to deploy forces in the first island chain. So this understanding that the US is withdrawing is complete nonsense. All of the upgrades to Okinawa base, which is the US's primary staging hub, and Guam, which is its second most important staging hub. Those have all been upgraded so that they can deploy quickly on all the first island chains and fight the battle. So the U.S. is moving into a forward posture, not a retreat. It's just
that
that,
that by the way, like, look, I'm
yeah,
sorry. That is one of the ones that drives me nuts. Like
yeah,
this idea that people say that this represents a retreat by the United States. It is absolutely not. One part of it is that, like, look, if you're going to have alliances, your allies actually have to step up. The second thing is that if you read any history of any great battle in world history,
yeah,
going back to Scipio Africanus, versus Hannibal. You read about, Frederick the Great. You read about, Napoleon. All these. One term will come up over and over and over in all these battles, and it's not just battles; it's also grand strategy as well, which is
hmm
the key issue here. Reserves. Reserves are probably the single most important strategic element of any battle, of any war, because
yeah,
it determines when your adversary is going to think, well, if I attack you here, where are the reserves that are going to back that up or come attack me from my flank? That
Absolutely.
is strategy. So you can't have all of your troops in South Korea. That's death. That is the worst strategy ever. So of
Or
course you pull it
exactly.
back to the second island chain. This is just basic strategy about being actually a deterrent against Chinese invasion. This,
Yeah, I know the press went nuts about the U.S. taking 5,000 Marines out of Okinawa and redeploying them in Hawaii and Guam, uh, while they completely upgraded the type of forces that they leave on the ground in Okinawa to be a multi-island strike force. I mean, the whole thing was a
and press their
military.
allies to do more. But this is exactly the point, is that this is a stronger deterrent than what was there before. That's the
Yeah,
whole point.
it's a quality adjustment, not a quantity adjustment, and all of the mainstream press just latch on to the first quantity estimate.
Yeah.
This issue about merchant marine supply perfectly fits your point. If you don't want to have a war with China because you know it will be the bloody worst thing that ever happens, you try to do every level of planning and preparing you can that doesn't provoke and does not
Yes.
trigger war. So all of the focus on shipping, contingent shipping, and merchant marine escort, and supply lines and reserves, all of that you can do without provoking your enemy. And that's what they're doing. That's what this 2025 NSS is about. And the fact that people don't understand that means they haven't been paying very much attention to the transition that the Defense Department has been going through over the last 5 years. This is not Trump is actually not altering the trajectory that much, really, other than this emphasis on restraint, which I think probably will be welcomed by the Defense Department because, we're in a situation where the U.S. does not want to go to war yet. It's not ready. It's not war ready. So it wants restraint and it wants time to build up its forces and upgrade its capabilities, etc. So for me, the NSS, where forget the tone and the belligerence or in short form or whatever, looking at what was emphasized in terms of priorities, I thought it was intelligent, falls in the same mold of conserving your resources, redeploying intelligently, and collaborating with your existing allies and not abandoning any of them. Just explain to them the new reality that we're going to do this together on the front line. Because what the number one thing is, U.S. predominance in all these places that are far from shore is based on aircraft carrier groups. And we all
Which will
know
be taken
Chinese
out
just have
immediately with
missiles that can
hypersonic
blow those
missiles.
up in a second now. So this is there's no, if you don't have aircraft carriers, you need the host country to work
Yes.
with you to build up infrastructure. And believe me, building up this infrastructure is not popular. This is why Takaichi is suffering so much in diet debate because these islands, they don't want to have missile bases in their countries because they remember from World War II what that means. So it's unpopular, but it has to be done and it has to replace the aircraft carrier strategy.
Yeah, the aircraft carriers are not going to be there. They will be taken out within seconds. Well, maybe not seconds, minutes.
They will
Um,
have to be far enough that the defensive shields can protect them. So that's second island chain stuff.
well, I mean, even there, like when you think about, like I can't remember what I had all these terms, and it's in that piece I referred to 2 years ago. But like both the Russians actually originally developed it, and the Chinese made a copy of it. They have these missiles that are container based, like container
Yeah.
ships,
Yeah.
and the largest container ships in the world are China's. The entire what I can't remember what the percentage of container ships around the world are Chinese owned and flagged at this point. And if you don't want to think that many of those have these anti-ship missiles on them all throughout the world and in ports all around the world, it's not just in the second island chain. Literally every U.S. aircraft carrier is going to be sunk in the opening minutes of the war. that's just a
Well, the
fact.
truth is there's not that many shipping lanes out there cutting through the second island chain, and in the event of a blockade, China would go into defensive posture. So there would hopefully be a lot less commercial craft out there in that area. But you're right. I mean, there's going to be open deep sea battles if China and the U.S. are really going at each other,
Yeah.
and so preserving your assets is going to be a big issue, and that puts so much more pressure on the first island chain, Philippines, Taiwan, and the Ryukyu Islands. This is where it would all take place. But I have to say, I am convinced the US is definitively trying to send the message to China, we don't want war. I mean, they mention no change in status quo in almost every document and pronouncement they put out. Not only no change in status quo of the Taiwan Strait, but just no change in status quo anywhere. North Korea, South Korea, any of the
Well,
hotspots, because they want to preserve peace.
yeah, not only that. I mean, they're clearly preparing for war, as you highlight, with build out of supply lines, creation of reserve forces in strategic positions, all of these things to put you on notice. Hey, if you want to go down this road, we're preparing for this, but we're
Yeah.
not looking for this, to your
Yes.
point. And the other big thing in there, which everyone sees, is again this retreat. And yeah, there is a whole retreat element of it, but it's part of preserving that reserve force and also
Yeah.
making yourself more secure, is the refocus on the Western Hemisphere, right? And
Yes.
shifting back to, hey, new Monroe Doctrine, we're going back to that. This is our place. But there's an implicit message in that, which is that you, China, we're not going to stomp on you. We're not interested in being in your sphere or anything like that. We're not looking to create a change in the status quo here, to exactly
Yes.
your point.
Yeah, and I think there was even very clear bullet points in the Western Hemisphere portion. Things like when they said expanding access in strategically important areas. I mean, everyone should understand this is just code for saying Panama Canal,
Yeah.
Greenland, Caribbean Sea, all of these choke points what the US has to control, and then to dislodge through, I think the term they use, identify, non-hemispheric ownership and positions and try to resolve that. So it's literally you're going to push Russia and China out of all of these dangerous choke points in the Western Hemisphere. So you just saw they announced they're going to upgrade Peru, or Trump wants to upgrade Peru to the highest level of non-NATO ally, because China's built a big deep water port there. So they're doing the same in Argentina, and they're doing the same in Colombia, and they're trying to do the same in Venezuela. And so just pushing Russia and China out of South America, I think, is also part of this how to confront your rival who you don't want to have a bloody war with without triggering the kinetic war. So to me, it falls into the same category as fortifying the first island chain and second island chain. Clear your rival from your
Exactly.
hemispheric sphere of influence, because they kind of have to accept that they're not going to go to world war because they're being pushed out of your sphere of influence.
Yeah.
But it's all the precursors to war, and that's frightening for people.
So quickly, and we're gonna have to close off here in the next 5 minutes. And I want to ask you some quick takes on 2026, just as a final question. But what are the sort of key market implications of the NSS from your perspective? Like, what does this mean? What are the investment themes that we should be thinking about there?
Well, the big performers for 2025, were AI, tech, banking, as we mentioned, and precious metals. Again, kind of a hedge against this world we're talking about. What could have done more, in my opinion, were commodities, base commodities. So I think, there's a big catch-up trade probably coming for Aussie and CAD, and the commodity currencies in general, and maybe, base metal mining stocks as well. So I like commodities still. I liked them last year, but I like them more for 2026. Energy is still not resolved. This energy dominance theme that I think Trump push forward. So far has only played out in the fossil fuel space. I think now it needs to continue to play out in electrical power generation as well. So heavy investment in nuclear and all forms of electrical power generation is still a hot topic, I think. And then I would say the steeper yield curve, I think maybe mid trend is still a bit further to go. I think steeper yield curves globally, as we do have growth and enough inflation for these shorter interest rates to be in place. I mean, I think a lot of our podcasts in the past are talking about the Fed making a policy error because inflation comes back. That's possible. I don't know. We still have positive real yields in the US, unlike some other countries where they're flat to negative in Japan. So maybe they'll get lucky with some base effects and Q2 and AI deflation coming through to rescue them. I don't know. But if we have low short-term rates, steep yield curve, and higher growth, it's a pretty bullish story for 26 for commodities and typical cyclicals.
Yeah. I mean, I would add one thing to that, which is, one area where I think some of the media hysteria, I mean, I still think it's hysterical, but I think it's pointing at something that is a real issue associated with it, which is just the pressure on Europe. And
Yes.
Europe is the weakest link in the West by far.
Yeah.
Um, and the pressure on the European Union itself, which is already has enough internal pressure,
Yeah.
not just financial pressure, but political pressure. Like politically, the European Union is failing its constituents, and
Yes.
this is coming out. And then you have the NSS. Apparently, there's some private version, I don't know whether that's true or not, that is specifically highlighting state to state relationships. And by the way, you even get European response, like Friedrich Merz is even talking about, like, developing a stronger relationship bilaterally with the US. This is very much I think going to put severe pressure on Europe. And when I look at, you and I have talked about before that, the dollar has been oversold and on a tactical sell-off, and it has started to come back. I think you got a little bit of year-end action going on right now, which I'm kind of ignoring. We actually already are into the dollar strengthening trend in my view, if you exclude the last couple of weeks. But still, euro dollar, and forget about the um the level of it. If you look at option pricing, right? Option
Yeah.
pricing is telling you that they are not pricing in enough tail risk there, and in
Yeah.
particular that option pricing is still skewed in favor of euro calls over euro
Yeah.
puts is insane.
I know.
Absolutely insane.
Yeah. No, I agree with
That
you.
is, I don't know whether that's going to be a 2026 issue, but I would say the probability of a European crisis has gone up dramatically in the last month.
I agree. I think the threat to the EU and to EMU are tail risks that are worth, putting some speculative capital on because they're underpriced, like you say, and the risks have increased. I think the NSS, which mentioned, US's desire to have greater bilateral relationships with a few countries, Poland and Italy and Hungary and things like that come to mind, is actually legitimate. It's not aimed at undermining and triggering an EU collapse. It's simply the
It's
US
not,
wants
but I think it
bilateral
might be
relations.
it
It could
might
happen
be an
anyway.
additional
Yeah,
pressure.
it could play out that way anyway. So I do think it needs to be played that way. I am bearish on Euro too. I just think the US also wants stronger Northeast Asian currencies. The renminbi, the Korean won, Taiwanese dollar, Japanese yen, they all need to be stronger. If they're not going to get there through, rate hikes, they're going to have to use FX intervention and moral suasion on these big, and net investment position countries that I've been writing about because, you have Taiwan, South Korea, Japan, and China, in the top 10 NIIP countries in the world. And yet, this is where this global conflict is going to emerge. I mean, honestly, they need to repatriate some of that capital and invest it in their defensive architecture. And the U.S. is going to be putting pressure on that. I don't know how that plays out exactly. Gradually, through some asset allocation changes by Korea, Japan, and Taiwan, I think in 2026, maybe FX intervention with the BOJ. So the dollar doesn't, one part of the dollar index, might be weakening with North Asia and commodity currencies, but the euro part should definitely be going down.
Yeah. So we need to close it off here, and this being, I think this is going to be the last one we're going to do for the year. So let me. You've already sort of, to some extent, answered this question, but what are some of the key things that you're focused on for 2026? Just in
Well,
brief.
yeah, I think we need a European deep dive. Maybe we can put Europe on the schedule for podcasts in January because I feel like I need to get a playbook for
Yeah,
how these tail risks unwind because they're important. Um,
and potentially huge.
yeah, and pretty huge. So I had a very good year investing tech stock. So I'm very focused on will that rally continue into 2026, slowly getting my courage back up. I think if we don't have an inflation episode, it's looking like a pretty bullish setup. I think the steepening of the yield curve is signaling growth. It's not signaling recession. So I'm encouraged. 2026 looks like better growth to US, less hysteria around Trump, and maybe some reality sinking in with the US's allies so that it becomes less difficult to alter everyone's worldview in 2026.
Yeah, so for me it's definitely I do think that that dollar rebound is coming back. I think that's something you and I are both agreed on. You've written about that as well. I definitely think that interest rates are going to be higher than what people expect. We're going to get probably a bear steepening first because of the shock of what people are going to see what the new Fed chair really means.
Good point.
And even though I'm less concerned about how the balance sheet actually affects long end rates, that's not the market view,
Yeah.
and this is going to have a big effect on that. And then as they learn to this point that inflation is just not going to come down unless they actually start raising policy rates to I would say even a neutral level. We are below neutral. There's no question about that. Then you are going to see that they're going to have to raise front end rates. And so that's going to be a bear flattening later. Both of those are going to mean that equities are going to struggle to perform next year in aggregate, right? Because your discount factor is going to be going up. So this is going to be a lot like 2022, solid earnings growth, and equity still underperform because you're getting this effect. I do think, to your point about tech stocks and others, look, I don't think that we're in an AI bubble. I've written about that before, but I do think that there's plenty of room for a catch up, whether it's going to be on bank stocks, as we talked about earlier, or whether
Yeah.
it's going to be around, frankly, the reindustrialization theme, and that finally, industrials and, mid and small caps are going to catch up a bit with the outperformance of large caps over the last few years.
Mm.
Those are going to be key themes. I think you're right on the commodities, particularly the commodity currencies. Those are going to be, I think, important. And I think Latin America, not across the board. There are going to be some bad stories in there. Brazil, I still continue to be, bearish on Brazil, but I think there are going to be some very positive stories coming out of Latin America.
Yeah, that sounds good. That's a good wrap up. I'm leaning towards this being 1996, 97 rather than 2019, but I can easily be convinced to become more defensive by a few bad events happening in January.
By the way, the critical difference in that was that the Fed had acted fully proactively in 1994 and then didn't backtrack hardcore. They had a couple just insurance cuts to
Yeah.
level things out. This Fed has been totally irresponsible, and that's what sets up for a different view in my view. But I think that otherwise, I would totally agree with your outlook there. So
Okay.
let's
Sounds
see.
good.
I want to wish you and all our listeners out there a very Merry Christmas, Happy New Year, whatever other holidays you're celebrating, and good luck in 2026. You and I will come back to this in 2026. We'll come back to the first or second week of the year and see what we can do from there about how all these things come out. Maybe by then we'll know who the Fed chair is.
Be fantastic. All right,
Take
looking
care of
forward to
yourself,
it.
Mark.
See you next year.
See you. Bye. Just going back to the question of winners and losers, we have it, it sounds like you're very much aligned with the sort of global bifurcation thesis that there
Yes.
it is going to be about winners and losers along those lines. A lot of volatility along the fault lines.
Yeah.
I think the sort of mean return or average return is going to be higher in the U.S. aligned sphere because it's a market-oriented system.
Yep.
As the Chinese system of overcapacity and non-market client-state relationships doesn't leave a lot of room for profit. That doesn't mean there won't be alpha opportunities within that space,
Yeah.
but as a beta move, that's just not going to be appropriate in my view. I mean, is that the way I should take what?
Yeah, absolutely. So I'm focused on the Western centric part of the bifurcation and what are their choices going to be in the next 5 years? Because I think I have a better ability to envision that, and I've kind of constructed what I consider like circles of trust. The US is going to have an inner circle of trust, which I've defined at 5 eyes, 9, 14 eyes, where it's going to share all its highest level tech, and it will continue to push for interdependence and in a way that globalization attempted to do globally. But this is highest level trust. Then the second ring of trust is you can think of more as like NATO, Indo-Quad, OECD, where interdependence will be allowed and opportunities will be tried, will be tested and adjusted. And then you have the next layer, which maybe I think you can consider a kind of Western Hemisphere, where even though the U.S. historically not invested and defended the Northern Hemisphere, it now seems to be an imperative, which I think is good news for Latin America. So
Yeah,
Latin America is kind of in a sweet spot. It, commodities and energy as a sector, and the U.S. with an interest in increasing closeness and trust between the nations. But there's a few problems. China and Russia are already there as incumbents in some countries like Cuba and Venezuela, where they will need to be dislodged, and now Colombia from a different angle. So it won't be all peace and harmony in Latin America. But I think long-term goal is that U.S. is going to dial up its investment in South America and Western Hemisphere. And then the next ring out is non-aligned. And this is where I think it's interesting for countries like India. I think that China will make a play for India, will continue to make a play for Pakistan, it will continue to make play for countries like Egypt to try to persuade them, and we'll see how they respond. If they respond, and it will be difficult. But I think in terms of you want to think of where capital has already flowed in, and therefore in a risk of a panic exit, India is in a dangerous position. India has to play its cards well, or it can frighten off the global risk-averse capital. And I would say like North Korea and Japan and Taiwan have that unfortunate geographic location.
you mean South Korea.
But they're all singing to the same tune as Washington and investing and making the right choices. So capital flight is not a risk yet,
Yeah.
but China hasn't really dialed up its game there.
Yeah.
Countries in Southeast
You mean
Asia.
South Korea, but
So Southeast Asia, Vietnam and Myanmar and Bangladesh, those are three countries which I think are being courted from both sides, which will be interesting how that plays out. Indonesia is a bit like India, where it's a large, major economy and therefore has the potential for some strategic autonomy, but ultimately has to choose a side. And so it's going to have a lot of pressure put on it. And it might be one of those countries where it doesn't have the sufficient international buffers and it doesn't have the strength of institutions
to cope well with the risks that it's about to take. So, that's how I'm kind of looking at the world and choosing winners and losers.
Which I think fits very well with the whole, sort of La Casa Nostra Americana thesis, right? Is that it's all about the circles of trust, and that's what the sort of Trump bullying of allies has been about. It's like, look, if you're going to be in the inner circle of trust, you have to prove to the US that you merit that position. We've
Yeah.
given you it before. Now you have to prove you should be here because we need to be able to rely on you. And so I think that is definitely the right model to think about these things. Look, we're gonna have to close it off there because we've already gone over an hour here. So I'm going to thank you again for a wonderful discussion, and we'll come back to this again in 2 weeks.
Okay, thanks, Marvin. And next time you help me out on the energy front. You and your Circle of Friends on energy help me understand how we become an energy superpower in the US and still make profits in a private capital-owned world, okay?
Okay.